It's time for another edition of Phil's Tax Hacks and Other Retirement Facts, and we're going to talk about some tax tips as it is that time of the year. So we've got this Fidelity report we're going to go through with 8 tax tips, and we're going to see what a CPA thinks about those right here on Phil's Tax Hacks and Other Retirement Facts.
Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show.
Hey everybody, welcome into the podcast. Phil and I back here to talk investing, finance, and retirement, and taxes. Yay. It's that time of the year, Phil.
It's that time of year. That time of year.
Fully entrenched, I'm sure, in taxes while we're
talking.
Clock
is ticking.
Yeah. So I've got 8 tax pitfalls to avoid from Fidelity, from the folks over at Fidelity. We're going to go through these and see what you think on these.
Sure.
Do some CPA thoughts on that. Key takeaways: math errors are common, but missed opportunities and deductions and credits could impact your wallet. Duh. That seems kind of like a no-brainer, right? So anyway, how you doing? Let's get into this conversation this week. But you doing all right?
Doing good. Yeah.
Yeah.
Looking forward to the 15th.
To be done?
To be done. Yeah. Yep.
But what about extensions?
It's always good to see that. So we try not to do extensions. I mean, it inevitably happens, you know.
Okay.
But,
just a few here and there.
We'll try to crunch out as many of them as we can before the 15th, just to make sure we're not dragging this on into the summer months. So, but we always have a handful of clients, that's fine. That's fine. Part of the process.
Yeah, as long as it's not too many.
They're in the same bucket as mine. Mine gets extended every year. So
I gotcha. Okay. Well, let's jump in and knock these out, Phil. So number 1, missing investment income. Okay. Is that something you see often, missing investment income? Like what is this all about here?
So, I mean, a lot of times it comes from, forgot about that account, right? I didn't realize I had that, or little accounts everywhere. So another good reason to have everything consolidated in one place, that way you're not looking for a half dozen 1099s at the end of the year. It's funny. I got an interesting story on that. I've got a client that I still work with that back in the day, they had a small home-based business, and she had inherited some stock from her grandparents. And back when she inherited it, it was such a small amount. It was paying just a small dividend being reinvested, and it wasn't issuing a 1099. No big deal.
Okay. Which, by the way, apparently $10 will generate a $10.
Yeah, $10 is that cutoff for interest or dividends.
So just FYI. But anyway, go ahead.
Yeah, so they missed it, and no big deal. And over the years, the amount of the investment had grown and started generating more dividend, and it was above that $10. Well, they had moved several times by now. And the company lost track of them. They lost track of the investment. All of a sudden, they get a notice from the IRS. Oh, by the way, we're auditing your return. You missed, XYZ dividends. Because for them, they had this business on the return too. So that, once the IRS picks it up and looks at it because they missed dividends, now they want to look at the rest of the return. So you don't want to miss investment income. Keep track of those little 1099s and accounts that you have out there. So,
all right, that's good. Sounds like a good point. A little tip there, right? So just don't miss, and then they don't come looking at you. So number 2,
don't give them a reason.
Don't give them a reason. Yeah, exactly. Number 2, selling too soon. Lots of information on the 1099, useful stuff. So I guess when we're talking about selling too soon, we're talking about getting rid of something with a capital gain.
So capital gains, there's 2 different types of gains you can have, short or long, right? So if it's a short-term gain held less than a year, it's taxed as ordinary income. So you're going to be taxed at those, the 10, 12, 22, 24, wherever you fall, those brackets, traditional ordinary income brackets. If you hold that investment for a year or more, now it becomes long-term. Now it's a different tax rate. It's either 0, so it could be 0% if you're in around that 12% bracket, or 15, or it could go up from there. It could be 20, but that's a significantly, that's a high bracket. But so, anyways, there could be a tax break, especially for somebody in that 22% is pretty average bracket. You're in that 22% bracket. If you sell a stock or an investment a month early, then ultimately you cost yourself 22 cents versus maybe it could have been at 15. So
gotcha. And so the difference being in whether it's a short term or a long term.
A short or a long term gain, or especially if you're even in the 12% bracket, it could be even better because you could pay no tax on it if it's long term, or you pay 12%.
And see here, it says if you're married, filing jointly, then you might be subject to the 3.8% Medicare net investment tax surtax on top of capital gains.
Even if you're
Right? So
single.
that
So
could
there,
be.
in addition,
Oh,
in addition to that, then there's another layer of tax, the Medicare surtax, the net investment income. So depending on what your adjusted gross income is, single or married, above, I think it's 2 or 250, then all that type of income, interest, dividends, that doesn't matter whether it's long or short term. It's just investment income is subject to
gotcha.
that tax. So,
Gotcha.
yep.
Okay. And we'll put a link to this article, by the way, in the show notes in the description for folks if they want to check it out as well. All right. Number 3 is poor record keeping. I'm sure that would annoy the CPA.
Well, yeah, I mean, and it makes your bill higher, right? If you're going to your CPA with this box of receipts, I mean, they're going to charge you a whole
true.
lot more for that than
If they got
if
to
you come
weed
with
through it.
if you come with a very organized, spreadsheet or however you keep your accounting records. But yeah, poor record keeping, not only does it make that time of the year more stressful, but it also, you miss things, right? I mean, if you're waiting until April 1st to try to start pulling these documents together, now you're up against the clock, and you're talking about remembering things that might have happened a year ago. So,
Yeah, true.
for most people, this isn't a big deal because they don't have a lot going on, in tax returns. This becomes a really big deal if you have rental properties, if you have a business, Schedule C, a small home-based business, or whatever it happens to be being reported on the return like that, where there's ongoing activity throughout the year. Now it becomes a big deal. You want to make sure you're keeping track of that kind of information. Don't wait till the end of the year. So,
Right. Right.
yep, have a
Okay.
good record keeping system in place.
Yeah.
And
And again, to save you money.
it saved you money. And at the end of the year, or later down the road, if you end up getting audited, you're going to need those records.
Yeah,
So you
that's
don't
true
want
too.
to. It was always funny to me when I had a joke with clients. We're in a tax meeting, and I ask them a number of something, and all of a sudden their eyes are looking at the ceiling, and I'm looking at my ceiling. I say, "Is it written up there somewhere?" It's like, no. Looking at the back of their head, trying to figure out what this number was. How many miles did you
Right.
drive for business last year?
You would think that with so many people now and so much stuff and so hard to, just life being so crazy that you almost think the IRS probably expects people not to be very organized. Who knows?
Oh,
They
sure.
want it, right? But I can't imagine that most people aren't disorganized sometimes by the time something rolls around. There's going to be some folks out there that are super organized, but I think most of us are probably like,
Oh, yeah, the vast majority of people, it's just not what
we're a
we do,
hot
not what we're
mess.
comfortable with it. It's like, yeah,
Yeah.
whatever.
Yeah.
I'll figure
Yeah.
that out
Okay.
later. I'll figure it out later.
Exactly.
So it's like anything, planning ahead and having the records up front makes it a whole lot easier.
It does make life easier for sure.
Mhm.
Yeah, exactly. All
Yep.
right, number 4, forgetting losses, Phil. So, like losses can be helpful, right? Because if you've got some winners, this
Right.
can basic tax loss harvesting is what we're talking about, right?
So there's a lot of ways that losses can come in. So forgetting losses, tax loss harvesting is a way, to help offset gains that might happen this year. So if you've sold some stocks, some investments at a gain, you're going to pay tax on those unless you can have losses to help offset it. So that's where this tax loss harvesting concept comes in play, is looking at your investments near the end of the year to say, okay, are there some losers that I can quote unquote harvest the loss? And you got to be
Right.
careful timing around, if you sell it, you can't just sell it and immediately repurchase because then that's a wash sale. We'll get into that in a second.
Okay.
But you've got to make sure that you're following the wash sale rules to be able to offset that loss. So that's one piece of it. To me, though, the bigger piece of these forgotten losses is just tracking it year to year. So, for instance, capital losses, you can offset losses in a year with the gains.
Mm-hmm.
But if at the end of it, you still have a net loss, you added up all the losses, all the gains you had, and you still had a loss for the year, well, the IRS allows you 3,000 of that loss to claim this year against ordinary income.
Okay.
The rest of that loss gets carried forward indefinitely. So this is where record keeping comes into play, making sure you're tracking, well, I had 10,000 of losses this year. I can
Mm-hmm.
only use 3. So that means next year I've got 7,000 that carries into that tax return. IRS is not going to remind you of that if you file a return and didn't claim it because they're not tracking it. They're
Right.
only really looking at what's going on in the return that year. you need to have those records to track those losses. Rental properties are another great example. If you have a rental property with a loss, if your income's above 150,000, you're not able to claim that loss this year, but the loss isn't lost forever. In fact, I'm working with a new client just yesterday that they brought in their past couple of years returns and prior CPA. Then he decided to do it himself last year. And then now he's wanting me to do it this year. So looking back through, I mean, he's got 200,000 of loss carryovers on his rental property because their income's above the 150 that he didn't even pick up last year. So had he continued to do this return, he would have missed all this loss that at some point could be offset against the sale of the property. So
Gotcha.
so it comes back to record keeping. Don't lose track of the losses.
All right, so what we're going to do is we're going to break this into two different podcasts because it is tax season, and obviously Phil's slamming with all this stuff as well. And so this week, and then this will be the last week of March, and then we're going to be back with another episode next week, which we do every week anyway. But we'll do these first four here. So missing investment income, right? Number one, selling too soon. Number two, poor record keeping. Number three, and forgetting losses. Number four. So you're going to kind of take those four pieces. And again, we'll put the links to the article in the show note details. And then we'll talk about the next four on next week's episode. But it's really important, Phil, overall. This is, again, why working with a CPA, right, can come into play and help you out because they're going to help you with a lot of this stuff.
Yep, absolutely. Yeah. And at the end of the day, you get the better result, the better records you keep and the more prepared of a preparer you're working with. So
when you guys put everything together for people, like, and then you're kind of set it, they bring you all their junk and you put it all together and you do all your stuff. Then you give them that folder back, right? Everybody gets that folder back. It's a little easier to the next year if you need something to reference that prior year's folder, right? To me, that just seems like it's all organized that way.
And we keep everything electronically ourselves, and we can provide that to clients we've got client portals that we can upload that into clients so they can keep track of that document electronically as well. So, and like client documents that they bring in, we're scanning all that information in because I don't want to keep the paper. Back in the day, we used to have half the building was storage of paper, which was just absurd.
Yeah.
We don't need that paper and it's hard to get into. You go back and I can remember digging through files and folders to find that one piece, so.
Yeah, that there is the beauty of technology in that, right?
That is one place the technology has really come around. So absolutely.
Yeah. Exactly. Well, good stuff. All right. So we'll jump out and we'll wrap this episode up. So if you need some help, folks, again, make sure you're talking with a qualified professional, especially when it comes to taxes and tax season. But also, think about it. We talk about it all the time. Phil's not only a CPA, but he's a personal financial specialist. And it's not just the CPA's job. And we talked about this many, many times on the show. They kind of look at the past year, but if you're working with someone who's also thinking about future tax implications, that can be a real win as well when it comes to, planning and getting prepared for retirement and just in general. So if you need some help, you got some questions, reach out to Phil and his team. Of course, you can find them online at philstaxhacks.com. That's our podcasting site, but it redirects you back to his main website. And you can subscribe to us on Apple or Spotify or YouTube if you're checking this out in video form, or some of the shorts as well. So don't forget to hit that little heart button or the little thumbs up button for notifications to catch new episodes when they come out. Again, find it all at philstaxhacks.com. That's philstaxhacks.com. And we'll be back with more tax tips next week here on the podcast. We'll see you next time.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.